Greetings and welcome to the Transform Podcast. This is Season 2, Episode 12. I'm your host, Christopher Anastasio. Today's guest is Nick Foster, founder of Foster Financial CPA. Nick Foster is a certified public accountant with over 2 decades of experience guiding business owners through complex tax and financial decisions. As the founder of Foster Financial CPA, a boutique firm based in Phoenix, Arizona, Nick specializes in tax strategy, advisory services, and payroll for entrepreneurs and growth-minded companies. Known for his strategic thinking and practical approach, Nick helps business owners keep more of what they earn while building financially sound foundations for long-term success. Nick, welcome to the podcast, and thank you so much for joining us today.
Thank you for having me.
Absolutely, yeah. Excited about the episode. Some real technical stuff that I want to dive into with you, but let's kind of start with a big question. We'll just kind of rip the Band-Aid off here. What would you say is the biggest misconception that entrepreneurs have about taxes and or financial strategy?
So I think there's kind of two, right? I think the biggest misconception is the theory that there's these huge tax loopholes, right? That they're just, oh, these things are out there, instead of having like real strategy about their business and what to do. We can dive deeper into other things, but a big misconception is people don't understand, it's a dollar saved, dollar earned. So a lot of business owners that we deal with before coming to us were kind of like, oh, well, if I go buy this truck, now I can save in taxes, right? And it's such a bad financial decision because you're letting I always say, don't let the tax tail wag the dog. And so by buying $100,000 vehicle with cash, you may be saving $25,000 in tax, but now you have $100,000 out of your bank account for a vehicle you didn't need.
I'm smiling, Nick, because this is the G-Wagon strategy that I've seen out there a lot. I think I might have even looked it up myself at one point, so that's why I was smiling. But please go ahead with the rest of your answer.
Yeah, I mean, there's so much to unravel on a misconception, right? Like that's such a vague question because there's so many nuances within it, right? A misconception of revenue, right? Like everybody, I always use it as the golf analogy. Everybody's always worried about what their revenue is. And I tell my clients all the time, I don't care about your revenue. I don't care how far you drive the ball. It's how you finish the hole and how much you're keeping in your pocket at any given time.
Got it. Yeah, no, I mean, in all seriousness, go on social media and most of the content of this sort of thing is, tax loophole A, tax loophole B. So I totally hear what you're saying there. Would you say, maybe as a follow-up to that, do you see the tax code as more of an advantage for business owners, something that exists to sort of help them, or is it still something you kind of would look at or describe as a burden to them that they need to sort of manage and sort of navigate like a minefield, so to speak?
Great question. I'm just thinking through how I want to answer it. I would say, it's all about being offensive, not defensive, right? I think, that's why there are CPAs, that's why there's firms, right? Is you have to be strategic in your thinking. Tax code is there for what the IRS wants people to do, right? And so I believe it's a huge benefit, but you have to play the game correctly, right? And so, if you look at, the tax Trump cuts that happened in 2008, there's a huge benefit with that, right? And that goes to a lot of other things, but you have this QBI deduction. So essentially anyone, if you make $100,000 as a business owner, you have a 20% reduction if you play the game right, and you're only paying tax on 80 grand. So you're paying only tax on 80%, right? And then the other piece to it is being a business owner as opposed to a W-2 is there's a lot of costs as a W-2 earner that they're getting that they're they have to pay after tax money on that you can have as a business. Sorry, I'm like losing my voice. Um,
No worry.
you can have as like a business deduction, whether it be a cell phone that you're using daily. Someone who is a W-2 earner has to pay their 25% tax to then pay for that $100 cell phone bill, whereas the business owner is paying for it pre-tax. So essentially, a business owner on many different things within their business, if it all makes a business sense, they're getting essentially a 25% discount on any expense they have.
Okay. Yeah, it makes sense. And definitely appreciate that answer. We did start, like I said, in the deep end there. Let's back up a little bit to I guess I'd call it your origin story, Nick. What initially drew you into accounting, tax advisory, that sort of thing? How did you get started there?
Oh, so I'm second generation CPA. I have my stepdad who's a CPA, had his own firm. In all honesty, I've always excelled in math and numbers, but you know, I full disclosure, I got into accounting because I was good at numbers, but I was like, oh, I would love a job that I only have to work 4 months out of the year through tax time, and then I can take the 8 months off. And that was just me being literally naive to the whole thing, right?
That's
And
fun.
so, my venture has kind of been an interesting venture because I started actually in corporate America. So I kind of went down the path of controller CFO, kind of like overseeing big companies, being in the corporate America world, and then started my own thing about 10 years ago to help people. And and it's evolved over time, right? And in seeing the biggest value to our clients is a giving them a pulse on their business at all times, but having the forward thinking looking of what's going on as opposed to the reactive thinking.
Okay. So, Nick, at what point did you realize, maybe it wasn't a single point in time, maybe not so likely that it was, but where you realized that business owners sort of misunderstood how the financial side of their companies work? Maybe they understood their business really well, but the financial was kind of escaping them. Is that something that you just came across, like you said, in corporate America, and you kind of, it's part of the reason you started your own thing, or how did that evolve for you?
I mean, I think that goes to I mean what I was kind of blown away with, and obviously dealing with accounting and numbers day in and day out, a lot of the things on a balance sheet or a P&L are easy for me to learn, right? But or to look at. But when you have business owners that you have a mechanic that's good at doing what they do for an auto, they don't know any of the other sides of it, right? So it's part of the education of, as a business owner, you don't have to be a CPA, you don't have to have the knowledge, but when you're looking at your financials, you should be able to understand what they're actually doing, and what it's saying. And the balance sheet tells more of a story than the profit and loss. And everybody always wants to just look at the income statement and say, how much money am I making? But they're not looking at their debt of what they're growing or the amount of money they're taking out of their business at any given time, right? Because that's telling a lot more of the story that banks are going to look at for loans or all of that.
So, given what you said there, Nick, like, take the mechanic, for example. I mean, he or she knows that business, maybe not so much the financial side. Do you see a pattern or something that sort of repeats itself amongst the business owners or individuals that you work with, where they're sort of making the same mistakes or the same things crop up over and over again with them?
I
If you
would
do
break
notice
that.
anything,
I
I
would
would.
probably, and the tough is like I think I would break that into beginning entrepreneurs and later entrepreneurs, right? Like beginning entrepreneurs, someone that's just starting a business, the biggest common theme I see is them not opening up a separate bank account, right? Or not having, I always say it's church and state, separating business to personal. And even if they do open a separate bank account, it's then them using their business bank account as their personal check register. So for a beginning person, it's understanding how to silo it and how to move the money out from business to personal to use it for your personal finances. And then, I think the later, the more tenured entrepreneur, I think is just them having to understand what they're doing in their business and what makes sense and what doesn't, right? And to be analyzing their data, with our clients, we have multiple different bars or multiple different whatever, and so we're kind of helping saying, well, you're paying 10% on advertising and this company is killing it, whereas you know the other company we're looking at is paying 30% and you're not getting any value for that, right? You got to look at the dollars and cents and your percent of expenses that you're spending and how it makes sense.
So, Nick, do you see a difference between newer generations of founders? I guess I would say younger people who have, let's say, got into this, early in their life versus the generation, let's say, pre-social media. I mean, is there any difference there in terms of generationally, more education versus less, or more ignorance versus less, or anything like that?
It's a great question. I don't know if I've ever really thought about it, to be honest with you. And so, um, I think if I would go back to, the biggest thing that's being talked about right now is using technologies, right? The AI, the whatever, right? And looking at the newer entrepreneurs, they're embracing the new technologies and how can that make more profitability for their company, but how can they leverage the different tools that are in our toolbox right now to be more efficient for their team so they're not doing stuff that they were, the world has changed since 2020, right? And, even with AI coming out, what, 4 years ago, and I was in strategic coach, and I remember someone showing me and me being like mind blown that this happened and where it's gone from that point, right? I mean, I'm using it to kind of analyze because I do fractional CFO work, so I'm using it to kind of analyze the fractional CFO. But it's just like having an employee where you still have to check the work, right? Because
Yeah.
I can tell you how many times, like I'm on my 15th iteration of a financial analytic tool because it's not spitting out what I need it to do. So, I know I'm going off subject, but I think that's the biggest difference of the generations is them embracing technology and, even from a marketing side, it used to be, oh, if you do Facebook ads or Google ads, that's going to generate revenue. And that's not the case anymore, right? Like it's a lot more difficult because of how the Google rankings are and how everything you have to basically pay Google a lot more to get your name on the front page. And it's not I'm trying to remember it, like the lead, like how many clicks, then it gets you on the front page of if someone searches that name. It's not like that anymore.
One of the things I was thinking of as you were saying that, Nick, and you mentioned the AI, and I definitely think that dovetails perfectly with the question about later generation versus current generation. Even the idea of like how do you get found in a large language model? How do you show up in ChatGPT or how do you show up in Gemini? I mean, that's the new SEO. That's the new, getting ranked on Google first.
Right.
Now you want to get shown up in a large language model. So the changes are they're coming so rapidly that it seems like, and this may not be the case at all, but it seems like a newer generation that has, like you said, totally embraced the technology, that's totally given into it, might be a little bit ahead of the curve on some of these things. But it doesn't always play out that way. But kind of an interesting test case to see if that was actually true or not.
Well, and like even just the market in general is changing. Like we used to have, from an accounting side, we used to have a ton of business coaches that were doing very well financially. And the coach thing has kind of definitely dropped off a lot, whether it be a health coach, whether it be whatever. And I don't know if it's the constraints of people and their income that they're not doing it. I like or it's being replaced by you can use ChatGPT to be your coach, right? Like
Yes.
I don't know what the paradigm shift happened, but I mean that's a huge different change in the market.
So Nick, just getting a little more practical in the next few questions I wanted to ask you. You had mentioned before in terms of like mistakes, like for example, you mentioned the bank account issue and mixing and so forth. If are there another one or two or three typical mistakes that you see sort of over and over again that you can kind of tell the audience like, hey, like check these things, make sure you're not doing these things that might apply mostly across the board to the audience.
So, I mean, I can say with us doing bookkeeping for 150 plus clients, right? Like, I would say one is if you hire a bookkeeper or whatever to send you financials, I would say a number one top mistake is literally they're not looking at the financials, right? You're not taking the time to understand what we're actually doing for you. And I think the misconception is, I think a lot of entrepreneurs think, okay, a financial is created just for a tax perspective, right? Is just for the IRS to know this is what I made. But I mean, it's literally telling you how the company is performing and how you can pivot during the year to kind of make it more profitable or where you're spending where you shouldn't. Um, and to kind of use that cash flow as leverage. That would be one. I think another one would be business owners not realizing that they're over distributing their money, right? Where they're using debt as leverage for their personal finance. And so that's another big one. Um, I would say another one in us taking on some clients that have had CPAs in the past, people default to just be like, we're going to make you an S-corp right away. And that doesn't make sense. I think if a business is running about 75 to $100,000 in profit in the year, it makes a lot of sense to make an S corp election. But there's additional cost to do it. You have to do payroll again. You have other things that you're having to do. You have an additional tax return. You have additional things. Any new person that's starting a business better not set up an S corp until they've hit a profitable threshold to make that work for them.
Yeah, I would say right with the G wagon advice, I see the S corp a lot out there on social platforms and so forth. But so glad you touched on that. We may even come back to that
And I
a
think
little bit
that's
later.
probably one of the biggest pains in our industry is the TikTok advice, right? It's, oh, I found this, this is what I should be doing. But the people that are saying it's an inch deep and not knowing how to set it all up for success, or it's not even a good strategy, right? And so that's probably been a big pain issue for us as being advisory for our clients is making sure they're doing the right thing. And I think, when you hire a CPA firm or when you hire a tax firm, whatever it is, or a bookkeeping firm that does taxes like us, it's you want to use them as a tool, right? It shouldn't just be, oh, here's my numbers. It should be, hey, I have this. I'm thinking about doing this. Instead of being making decisions on the whim, use your advisor as a help guide before making those crucial decisions.
Yeah, so let's just linger there for a second, Nick. It seems like the challenge that you have to face in your profession currently that maybe previous generations doing what you're doing didn't is you have to re-educate people. You have to unbrainwash them first if they've seen this sort of material, and then sort of reinstall the proper strategy or thinking. Is that a good take on on some of
Yeah,
the
I mean,
challenges
I
you've
think
had?
I think the role, even me having the firm for 10 years, has evolved, right? And changed, and for good. I think, what I love is helping people, and like that's the biggest part of of the role that we are is it's not just a tax practitioner, it's literally an advisory
Yeah.
person that can kind of help you. And, with taxes or tax planning, I always tell my clients, look, it's critical for every business that's making profits to have a tax planning session. You got to have a tax planning session in the fourth quarter because if you don't, your head's in the sand of what's going on. Right? And it's for two parts. I always say when the ball drops on 12/31, that's literally where all your tax strategy goes out the door as well, right? Because we can't retroact a lot of stuff. But, and I know I've said it before on another podcast, but the challenge is business owners can't keep their head in the sand of what their taxes are, right? And so part of a tax planning meeting is going, here's what you're going to owe, right? And here's the certain things we can do, right? Because then if you're not doing the tax planning meeting, and I can speak to my history and I don't know about others, but it's like the business owner, whatever, is pissed at us that they owe $40,000 come March or April for their tax return. It's like, this is on you, right? Like, so, a good entrepreneur should be putting money away on their profits all year for what's going to come and not just, okay, because that's what creates the stress for the entrepreneur is like, I made a lot of money. I took all that money out. Now come tax time, I don't have the money to pay for it, right? So it's about being very diligent with your cash flow and not overspending your lifestyle because your money is increasing. If your money's increasing, that's a good thing. Your business is growing, that's a good thing. But that probably means you're going to owe more tax, right? And so it's getting ahead of that. And so like, what we're doing now, because I deal with a lot of high net worth individuals, there are some high net worth individual plays. If someone's making over $1 million a year that you can save a lot of tax and it's an investment vehicle too. But just like any tax strategy, you have to pay to play, right? Like it's you have to, whether it's the solo 401k for a smaller business, it's moving money from one bucket to another, right? And if you're making $100,000 in profit, you can put 25% of that into a solo 401k. So that's taking a $25,000 expense off your bottom line, but it's putting it into your personal, but you have to have the money to be able to move that money.
Yep. So, Nick, this is a great segue. In fact, you started to answer this question already unwittingly. But when do you think a founder should start thinking seriously about tax strategy versus tax compliance? So, in other words, just instead of just staying out of trouble, they should start thinking ahead a little bit more strategically and that sort. Is it apply to everybody? They should do that from the
I,
get
I
go.
mean,
Is there a point where
I think it's profitability, right? I mean, it's once you're kind of hitting $50,000 of profitability, that's where it gets more fun on what you can do, right? And I think that would be my answer. $50,000, if you have, and we have other businesses where we're telling our clients, if you've had 3 years of continual losses as a Schedule C tax, on your business, the IRS is going to deem this a hobby, not a true business that shouldn't even be on Schedule C, because the purpose of a business is to literally make money.
and unfortunately it seems to be forgotten sometimes. Just as a follow up there, do you see, and I don't know if you can generalize this or not, but do you see more founders overpaying their taxes to be safe? Or do you see sort of the reverse, like more aggressive positions being taken that are maybe reckless or just not being as cautious as they should be? Is there a trend in either direction, or is it just kind of a mixed bag that you come across?
So when you say reckless, what do you mean by that? Just out
So
of curiosity.
yeah, do you see like when you first start to work with somebody before you've worked with them? Do you see business owners, let's say, going for all those tax loopholes, just trying to stack them up, trying to take advantage of everything that's out there, maybe when they shouldn't? just in a play to, let's say, reduce their taxes or something like that? Or do you notice that people tend to be more cautious, and they're happy overpaying just so they don't get in trouble with the IRS?
I I I think it's probably both, right?
Yep.
I think, there's not one size fits all for all of this, right? I think you have a lot of people that are very scared of the IRS, right? And it's just like, I don't want to do anything, and I get that, right? But it's to have the knowledge or the understanding that there are ways. Like, I had a client years ago, and and they had been making probably 200 grand in profit for probably 5 years before they came to us, and they were an LLC, right? And just a Schedule C on their business. And so I'm like, okay, well, here, using the S-corp tax strategy, it's like, okay, and we ended up saving them like $30,000 in tax that they've been paying the last 5 years, right? So that's money in their pocket that they could have kept. And I remember the conversation because she's like, I hope, are you sure this is okay? I hope we don't get in trouble by the IRS. Like, there's a fear of that, but just knowing, and I think, we bring on new clients all the time because, the two key components are, A, I think there's if you look at the age of CPAs, they're saying, uh, since COVID, like 25% of the CPAs got out of the industry altogether because that was a cluster during that time. But then they're saying like 80% of the current CPAs in the next 6 years are in retirement age. So you have a lot of CPAs out there that, let's call a spade, are probably burnt out and probably just not wanting to continue to learn and grow, and they just want to get what they can to get their revenues. So we have clients that we're bringing on constantly that are like, I don't have a relationship with my CPA. He just wants to do the numbers and do the tax return, but isn't looking out for me at all, or not replying to my emails, or not, and so it's trying to find the right person that can be strategic, to be looking forward and not just looking back. And that's, so I do like fractional CFO for small businesses. And so I have some clients that I'm spending an hour every quarter going through what a CFO would do for them. And I always say it's lonely at the top as a business owner, and that's kind of so where we go with it is we're literally going through their numbers, but then they get to ask the big questions of what's on their head that they're thinking they want to do, and does this make sense, right? And being able for me to challenge them in the thinking they're having, or B, making them eat their vegetables. Like, okay, you want to make profits, the whole profits first, you got to play that game.
Yep. Yep. So, Nick, where do you see the IRS tend to focus when they're auditing small businesses? Is there any kind of trend there? Anything you can kind of give the audience a heads up about, that this is a sensitive area, or they're going to look at this for sure, or anything like that?
I mean, that's the whole point of the NAICS code, right? Is putting all of this certain industry all in the same bucket to then see what matches up and what doesn't. Like, what's the anomaly? What's the red flag that this business is spending? They're making $150,000 in revenue, but they're spending $40,000 in meals, right? And it's training the clients too, that that's what we do is, you know you can charge a meal, and but the IRS code is you have to have what is the business purpose and who was there. And so even for our clients, we're doing the bookkeeping for them, but it's like, okay, I want you to, when you go to a meal, I want you to take a picture of that receipt, save it in your Google Doc, but write down what is the business name and the business, or the business purpose, and who was with you. So then you have documentation. If you were to get audited, you have all your backup with a timestamp showing you, so it's not an issue, right? And it's that onion that could come if you do get audited and one thing does not check out, then a lot of other things may not check out.
Gotcha. So Nick, I mentioned before we might come back to the S-corp thing. So I do want to come back there for a moment. And some of what you answer may be repetition from what you said before, but I actually think there's value in that because this is a big one that people get hung up on or jump too fast at. And I believe you said a range of numbers a moment ago, but can you go back over the point where somebody should step back and say, I was an LLC or I was operating this way, and now I should come over and start operating as an S corp. What's the tripwire that they should be kind of thinking about or look out for there when it comes to that?
So the first thing is you are an LLC, but designated taxed as an S corp. So you don't need to change your structure. You don't need to do any of that, right? And when, it's the compliance piece, right? If you are an LLC or an S corp, you should be doing annual meeting minutes of going over what's going on in your business to stay compliant. That I don't think probably 90% of businesses are probably doing. So, with the other thing with the S corp is, like we said, you have to have owner compensation. And so if a business, take a realtor for example, right? It makes sense if they're profitable, but they have to be diligent with their cash because they should be taking owner payroll every month and staying compliant with that, right? And so if a realtor does 3 deals in 1 month, but it's not doing another deal for another 3 months, they can't just take all that money out and go spend it because they still have to be running payroll because there's still a lot of profit in the business. And it's getting back to that whole QBI deduction you get the max QBI if you have 50% of your W-2 wages get you to that QBI. So if you're only taking, there's owners that we've taken on as clients that, oh, I'm making $150,000 in profit a year, but I'm only doing a $30,000 payroll. Like that's not going to be compliant. And the downside of that is you could lose your S corp status, which is a huge tax play. And to unravel the S corp more, the reason it's a value add is if you're a Schedule C, you have to pay self-employment tax. So what that means is if you're a W-2, you have to pay 7.65% as the employer and then 7.65 as the employee. So a Schedule C has to pay 15.3% on their tax. And that's not income tax, that's just above the line. So like we've had clients, like I said, that they're making 100 grand, but they're paying 35% tax rates because of the self-employment. Whereas if you're an S corp, the money flows through to your K1 and you don't have self-employment on it. But the IRS knows that. That's why you have to pay yourself payroll to stay compliant.
And Nick, you may have said it before, but is there a profitability figure that typically, when reached, it starts to make sense to become an S corp?
Yeah, I think 60 to 75 grand of profit kind of starts to make sense.
Gotcha.
Right? But like I said, the challenge is, and it's what's the best interest for the client. From a CPA firm, they want everybody to be that so they can charge an additional tax return, right? And get more fees in the door on their business. But it doesn't make sense. And being an S corp, like I said, you have additional costs because you have now someone having to do your payroll or whatever, so you're adding more burden onto the employer.
And so you mentioned a couple of these sort of headaches, the payroll, the extra tax return. These are the things you never see in the social media content. For the most part, it's all about the tax savings and what you can do and stuff like that. So are there any other, I guess I'd call them headaches or misunderstandings, if you will, that as somebody's about to make this decision, and maybe they're seduced in a way by, I'm going to save all this money and I'm going to pay less tax, that they should understand what they're taking on, that they're going to get the 1120S, they're going to, they got to get payroll set up. Is there anything else what about like bookkeeping, other bookkeeping requirements, or there are other types of headaches like that they have to be aware of?
I have a. Do you hear that weird sound? Um, that's
I
a
did.
weird sound. Uh, I don't know if there is. I think those are the biggest costs, right? But like I said, I mean, the headache is keeping your cash flow to be doing your payroll. And and we it's happened in our world where we're running payroll for a client and they're like, "Well, we don't have money." And it's like, well, and they're not knowing that the direct deposit's going to go into their account, but not factoring in the additional costs of the payroll taxes that come out of their account. So we'll have a payroll tax bounce or stuff like that that they need to know they have to have the whole cash for the whole payroll run.
Maybe getting to something you said a little bit earlier, in the inverse, somebody who's hesitant to become an S corp, is there any truth to it, or is it just a myth that if you turn yourself, into the S corp status from just being a regular LLC, that you now get onto the IRS's radar, that you have a higher audit risk or something like that, or is that just something somebody could get hung up on for no reason at all?
Yeah, I think that's a hang up. I mean, and I'm saying this and it sounds really bad, but it's actually like I just read a Wall Street Journal article literally like 2 weeks ago, and I'm saying this and it's being recorded, so I hope I don't get slapped. But the reality is the IRS is like a fraction of what it used to be, right?
I
So
think I saw that article actually.
so the audit risk is lower. Now maybe they're using technologies like we were talking about before to help them with that, right? But at the same time, someone who's and I'm going to say it, someone who's making 100 grand probably doesn't have as much audit risk as someone who's making $1.2 million, right? And I did fractional CFO for a family. I was a fractional CFO for a family office, and I can tell you was he had multiple businesses in multiple states, multiple state audits going on at the same time, and he was making $8 to $10 million every year. So they were like, where can we find the rocks to get more tax out of them? And the different states, the California, obviously, owning a business in California, it's going to cost you $750 even if you do nothing, just for the franchise tax board.
Yeah, got it. Um, Probably could make a whole episode out of California. Move along to the next question. Before we shift gears, are there any, we talked about the vehicle. I think one of the first things you mentioned was like people getting hung up on the vehicle situation and trying to save tax that way. We talked about the S Corp. Are there any other tax moves that like people think are smart on paper, but they typically backfire on them? Some of these bigger things that, circulate online, stuff like that. Any red flags that you would
Well,
highlight?
like, give me an instance.
So, let's say somebody sees something. Well, I mean, I've definitely seen the one about the vehicle. Like if you buy the $100,000 vehicle, you're going to save, the
Well,
whatever the
well,
deduction is
and we
for
can
that.
probably even extend on that is, the other TikTok notion that's going out there is you should buy a vehicle every year, right? And that's even worse information because if we go into the numbers, and I'm getting into it, is okay, I buy $100,000 vehicle year one. I get full depreciation year one. So from an IRS standpoint, yeah, you got your $100,000 write-off, but now that vehicle is worth nothing. So now, year two, you buy the vehicle and you trade in the other vehicle, you're paying gains now on 80 grand on the new vehicle, so you're not getting a benefit the following year, right? Someone, what I think is crazy, and I totally think it's like the best advice I've heard in a while, and it was by my great uncle, but he was like, a vehicle is your biggest cost ever in life. And if you go through, it's a depreciating asset. So the value of you buying it today, it's not worth the same tomorrow. So it's going down in value, and your maintenance, all your costs to keep that thing going is expensive. And so we all want that I'm going deep here, so bear with me. But we all want like the lifestyle and looking lavish and luxurious, right? And that's problem with society in general. But it's your number one cost, right? Like a house, people would argue, oh, the house is the number one cost. But your house over time is going to appreciate, in theory, it has. And so, that is still growing over time for you. Whereas a car, once it gets to 120,000 miles, it's kind of has no value, right? And, you know, so
Okay, no, that was a great answer to the question. And sometimes the depth helps like that. So, um, as we get close to winding things down, I did want to switch gears to like the future of tax and tax policy. Just sort of get some of your views on that. Do you expect that tax policy is going to generally become more or less favorable to entrepreneurs in the coming years? Just your gut feeling, what you see day to day in your business. Is it kind of trending up or trending down if somebody's thinking about starting a business?
I mean, no one has a crystal ball, right? But we can, if you look at the government debt and everything else, you could probably guarantee one thing is true that taxes will go up over time. But like I said, America in general is based on entrepreneurship, and that's the vehicle that keeps the the foundation running. So I see it's definitely, and I know we're talking about tax strategy and everything. I mean, I think as a holistic thing, I think as a entrepreneur, it's a good thing. There are a huge tax benefits like we talked about previously. But what isn't talked about a lot on TikTok or whatever is it's tough to be an entrepreneur. And no one, and I don't know if you've seen the picture of like people see all this on top of the water of like, oh, they're doing great, but not all the stuff that's underneath. And I, like I said, this is going off topic for this show, but it needs to be said that entrepreneurship is not for everybody. Are you willing to put in the time, the hours, the brain damage, right? You may have more flexibility on your schedule, but that brain is never stopping on wherever it is. Like sleepless nights of employees that aren't working out, or sleepless nights of how am I going to cover payroll for these people? Because when you have employees, as a business owner, a good business owner, you are paid last. You are making sure everybody is in line in front of you before you ever take a cent. And so there's a lot that goes in that as an entrepreneur that people don't think about. So it's the whole, oh, everybody should start their own business. But, if profits aren't going good and you have to feed your family, you know, there is something to be said about a W-2 earner, right? Like you have stress, and yeah, it sucks that you can't control your schedule as well, but you're guaranteed that paycheck's coming every week. And that's a whole nother thing. So sorry for going off on that, but
No, actually, that's perfect, and I think there's even a little segue in there. Some of the questions I'm about to ask you, uh, but before we do that, do you see any potential changes coming to taxes in general? This area we've been talking mostly about that people should be aware of. I mean, you did mention the article, in terms of what's happened to the IRS. I think I saw this.
yeah, I mean, I don't know, right? And because the biggest thing is like, the Trump tax cuts, those were ready to expire this year, and they made a lot of those things permanent, right? But the question is, if someone else new comes into to office, does that change the whole landscape again? Who knows, right? Like, and I never play in the crystal ball world, right? We have to play with what we know today. But like I said, I mean, going into it, that's where I'm saying knowing taxes are going to go up over our lifetime, um, people using the Roth IRA makes a lot of sense because now you're putting money into your retirement post-tax, and when you take that out when you're retired, it's not taxable. So who cares if the tax rate goes up?
Yeah. So before we get into the rapid fire to wrap things up, if you were advising, this kind of goes to what you were saying before about just entrepreneurship in general, but if you were advising a young or a budding entrepreneur today, what financial habits do you think are most important for them to develop, or what are some of the things that they should focus on there as they get started?
Number one is knowing your numbers, right? And we've talked about it before. But if you are not looking at your numbers, and we've brought on clients that, oh, I don't get my financials from my bookkeeper till the year's over. You can't run your business without knowing your numbers, and you're flying blind. And it's utilizing, whether it be the AI world or whether it be your advisor, is to literally have someone help you understand what these numbers represent. Like that is so critical. And, I have a very successful construction company that I help, and he's a good friend of mine. And like, so proud of him. When he was younger, he actually took accounting classes so he could try and understand some of it, right? I think that is number one. And then number two, from a business standpoint, is people say follow your passions. I don't agree with that. What are you good at? And it's a grind, and you got to be willing to put in the work. Are you willing to work harder than most to figure out the different strategies or solutions that make your business run better? I'm not saying work hard, but it's using AI right now it's a lot of headache on anyone that's an entrepreneur, because you're now taking a bowl of spaghetti you've already been running as a business, and now trying to bring in this new technology into the spaghetti, which makes it a lot difficult to figure out how to understand, right? So if I was to tell an entrepreneur today that's going to go start their own business tomorrow, figure out what AI tools you can use from day one, and get that tuned and humming to where it makes it scalable quickly.
Okay. Um, no, that's great. That's great advice, great insight. So let's do the rapid fire, Nick. We'll try to tick these off real fast. And some of you may have already touched on. In fact, I think the first one you definitely touched on, but most overrated tax strategy.
Oh, we did touch on that, but the other one is going back to dollar saved, dollar earned, right? I think the most overrated tax strategy is I have to get every expense in my business so I don't pay taxes. But if your tax rate's 20%, why go buy whatever just to save that 20% tax rate? I think that is the number one for me. Is
Okay.
just cash flow perspective.
Is there an underrated tax strategy? We didn't quite talk about that as much.
We did a little. I would say underrated is, taking on new clients and not fully utilizing the QBI deduction. I think that is a big one. Not having someone doing the tax planning to see where it can be maxed. I think, and then two is kind of, like I said, knowing your cash flow and keeping cash in the business, because you can put a ton of money in your own retirement account. The way the tax laws are written, you can put like you can put 25% of what you are paid in there, plus you can max it out as the employee. So you can be putting $55,000 essentially pre-tax into your own 401k and get an expense at the business level, right? So it's just maxing out those kind of things. I would say from a personal to uh, entrepreneur, like even if you're W-2, like, and if you have a high deductible, plan for medical, that HSA is a game changer as well because you're putting money into it tax free, and you can use that for any medical bills along the way, and then you're putting it in tax free because it's reducing your AGI at that point, and then that can actually become an investment vehicle once you start to have money in that HSA account. You put it in investments and that grows tax free, right? So there's a lot there that people aren't fully utilizing that they should.
That's great stuff, Nick. Um, There's another one I think you already answered. One financial habit every entrepreneur should adopt. I think you talked about knowing the numbers, having a fluency at that. Maybe a
Yeah, and
runner
I
to
think
that.
like cash, knowing how your business runs, right? I would say, the biggest thing is your cash is your king. And so knowing that if you know, if you don't use your cash correctly, you're going to cash flow is what's going to make your business grow. Cash flow is going to what propels to do tax strategies, you know, not increasing your lifestyle based on the profitability of your current financial success.
Excellent. One financial metric founders ignore but shouldn't. Or is there one? It should be confined to one.
The financial metric there that a lot of people aren't looking at, like we talked about before, is the balance sheet,
Okay.
right? Is knowing what that means and knowing, how from year over year, how your debt is going, or what are you paying off? What are you using your business for? What kind of assets are you buying? If you get more sophisticated as a business owner, you should be looking at your aging accounts receivable, right? That's a lot of low-hanging fruit from the CFO role that I'm always looking at is like there's, your AR, I look at the aging AR and there's aging receivables in there from a year ago or 2 years ago. And so that was not, you're not getting taxed on that if you're cash basis, but that's counted as profit in prior years that you counted that is pretty much obsolete at this point, right? And who is controlling your cash collection position because that is the fuel for the company. And so if you have a 90 days overdue, well, someone should be picking up the phone and make sure that they're collecting that cash.
No, that's great. Let's wrap up on this sort of final question. If a founder is listening today, wanted to become more financially literate, financially smarter in the next 12 months, what should they start doing immediately? Is it studying financial statements or something else be above and beyond that?
Um, I mean, I think any person, whether it be an entrepreneur or person, should invest in themselves and in reading, right? Like I found in my early 30s, that's when I started to become a reader. And it's like, I think that, we go through school and these are mandatory reading things, but to spend time reading from people that have taken their whole life's work and put it into a book. And I know I'm kind of answering your question, but there's a book and it escapes me right now. Oh, it's The Psychology of Money. And I think it's an amazing book because it's kind of laying the foundation of we all come from our past with how we view money. And if we're not looking at how internally we view money, if you believe you're only supposed to make $1,000, well, I guarantee you, or you believe you came from nothing and you're going to die with nothing. So anytime you have money, you're going to make bad financial decisions just because of that, right? And so it's just being very and knowing, like I said, I'm saying it again, I've said it on multiple podcasts, but it's the power of 72, right? It's not about just taxes, it's about, taxes save you long term, But if you're investing your profits and not increasing your lifestyle and saving that money over time, Power of 72 is whatever return rate of return you have on your investments. If it's 10%, it takes your money 7.2 years to double. And so it's the old books, Think and Grow Rich, right? Like it's all these books that you can take, and they're all old, but they still apply today. And you got to learn how to play the game, not just from a tax perspective, but just in general on what has worked repeating over and over again. And that's how you should run your financial life and your personal life.
That really resonates with me, Nick. I'm an avid reader. I have a 6-year-old son, so there's limitations to that, but I try to read as much as possible. I just wrote down that title that you mentioned, and just the other day, last 24, 48 hours, I was watching somebody advocate for reading The Richest Man in Babylon
Yeah.
and the compound, the power
Yeah.
of compounding. And I was like, I've never read that book. I'm so interested in this topic. I've never read that. So, both of these, the one you mentioned and that one, I've got notes to.
Richest Man in Babylon, another good one, right? That the gold starts working for you, and it's almost like you have a workforce making you money. Like I have a 14-year-old daughter, 12-year-old daughter, and a 7-year-old daughter, or I have 12-year-old son. I hope he's not listening. I'm actually it's sad that they're about to be out of the house, and it's going quick. But I'm starting to the first book I'm having him read, and I read it when I was a freshman in high school, was Rich Dad Poor Dad.
Yes.
And it's a fundamental accounting book, but it's
Yes.
also talking on how putting assets to play works over time. And so,
Yeah.
my 14 and 12-year-old, they're reading it, and we're having almost like a book report chapter discussion on, what questions do you have? Because I know when I was reading at 15, it was like it was accounting, and some of it was like way over my head. These assets, these liabilities, these, but it's then having the so I'm having to reread it with them. So it's having the conversations for them to understand what's going on.
Yeah, really enjoyed you talking about that, Nick. I remember the month and year that I read that book, and I have Cash Flow for Kids for my son, and we play that game as much as possible.
Do you
But yeah,
see? I have that same game too, and I tried it like 3 times with my family. I didn't like it.
okay.
And so maybe I'm not playing it right, but I'm like, I just felt like it didn't. I don't know.
It's a little bit, the Cash Flow for Kids is definitely on the basic side, and for my 6-year-old, it's kind of perfect for him to
Right.
follow along with and stuff. He may have already lost some interest in it. Maybe time to go up to 101, I think, is the next one. But yeah, I mean, just in terms of the Rich Dad Poor Dad series, could not agree with you more. It's where I kind of started my interest in this topic and started pulling the thread.
Yeah, and I
Yeah.
think that's, from an accounting standpoint, right? Like getting out of school, you know nothing, right? And what I tell people is thank God for podcasts, because that's what got me through my first few years of accounting. Because if I didn't have podcasts in my ear, I am an outgoing CPA, and man, I would have left the industry. So, I love podcasts, but yeah, but as you go further in this career, what fills me up is helping people, right? And whether it be the tax side, whether it be the CFO side of like how do we make this work better, or what strategies can we put in place? That's the fun
Yep.
stuff.
Yep. Well, this has been a really, really fun episode for me, Nick. I'm even personally as a little geek factor to it for me, so I really, really enjoyed it. Where can people find you if they want to follow you, learn more about what you're doing? Where can
Yeah, I
they?
mean, I'm posting on my LinkedIn. They can go to fosterfinancialcpa.com. We're just always looking to help people and grow their awareness. And like I said, it's a hard part being an entrepreneur, but it's fun at the same time. And so every
Absolutely.
day is a blessing, and you gotta live from gratitude. And each challenge makes it more fun when you come from the other side.
Absolutely. Well, thank you so much for joining us today, Nick. I think this episode is going to resonate very strongly with our audience and do very well. And I really can't thank you enough for being here today.
Thank you so much for having me. Have a great weekend.
Thanks, Nick. Hope to have you back soon.
All right. Take it easy. Bye-bye.